Very good evening to all my dear friends. My name is Devender and today I am present here to discuss some of the most important topics of the national income and the concepts of national income that is asked in every examinations. And by watching this session, you will feel that all the doubts relating to the national income are cleared. Okay, so it is a very important topic for the SSC examinations, or you can say the state level examinations, or even the state civil services examinations. Okay, so as you have seen in the thumbnail, we are going to discuss in today's session about the national income. Okay, so so I would request you all to share the session so that the maximum people can join the session. Okay, I request you all to join the session and also share the session so that the maximum people can join the event. Now, before beginning the session, I want to quote a very important quote by the Walt Disney. And he once said, all our dreams can come true if we have the courage to pursue them. Okay, so all the dreams that you have dreamt in your life can be fulfilled if you work on them and you have the courage to pursue them. So first of all, dream big, and also make your habits or your also make your it is a habit so that you can work on these uh, dreams. Okay, so it is a very important quote. All our dreams can come true if we have the courage to pursue them. So it is quoted by Walt Disney. Okay, and he is the founder of the Disney network. Now in today's session we are going to discuss very important topic, as I have already said, and the topic name is national income. And in today's session we are going to discuss the concept of national income and what do you mean by circular flow of income, and also the concept of GDP, GNP, NDP and NNP. Okay, so all these are the very important points, and we are also going to discuss the measurement of national income and what are the what are the methods of calculating national income. Okay, so here are the methods. One method is expenditure method, other one is value addition method, income method and GDP deflator. Okay, so this event is going to be very important for you, and don't miss the chance to watch the video. Okay, so this is a very important event for every aspirant who is going to appear for the examinations. Yes, so who all are watching, please comment in the comment box so that I can also be assured that you are watching and you are also interested in the topic. Okay, so comment in the comment box. So what do you mean by national income? So before getting into the national income, you should remember, or you should also know the meaning of the annual income. Okay, so what is the annual income? So if I ask some students in my offline batches what is the annual income, so they say that annual income is the monthly income multiplied into 12. Okay, so whatever a person earns in a month, whatever a person earns in a month is multiplied by 12 is known as annual income. Monthly income into 12 is known as the annual income. But this is not true in every sense. Okay, in every sphere of life this formula is not true. But why? What is the reason behind this? Because in some month of the year we have more income than the previous one. Okay, or you can say we have the less income in the month than the previous one, or more income in the current month. So the income of a household from various sources during a year is known as, from the salary, bonus, rent, interest, etc., is known as annual income. Okay, so whatever a person earns in a year by different means of income is known as annual income. Okay, and the means can be salary, bonus, rent, interest, etc. Okay, so what is the concept of national income? Okay, the national income is defined as the money value. National income is defined as the money value of all the final goods and services produced within the domestic territory of a nation during a year. Okay, so it is the net result of economic activities of a country during a year. Okay, so you should remember the definition of the national income very properly, because it has been asked in a statement wise questions. Okay, so I repeat once again, national income is defined as the money value of all the final goods and services produced by the country in its domestic territory during a year is known as national income. Okay, so it is valued in terms of money. It is valued in terms of money. What does it mean? What does it mean? What is the term where it is valued or measured in terms of money? So what does the statement want to signify, or what does the statement want to say? Yes, what does the statement want to say? So the statement want to say that if we prepare our books of account, and in the books of account we say that I have 200 cars. Okay, I have 4 bungalows, I have 5 factories, I have 2 farms. So nobody can assess what do you want to say. Okay, what is the actual value of all these assets? So to prepare our books of accounts very neat and clean and comprehensible, so we have to write all the assets in our balance sheet, or you can say in our profit and loss account, in the terms of money. Okay, suppose that a steel, or you can say the iron and steel company produces 5,000 tons of steel, so it cannot write the 5,000 tons of steel. Okay, it will write in the books of account in the terms of money. Okay, if there is a farmer who produces 500 tons of grain, okay, so he will not write the 500 tons of grain. Okay, he will write in terms of money, so that the comparison or the calculation of the national income can be made easy. Okay, so it is the meaning of the terms of money. Now I hope you all understood the meaning of the national income, as well as what is the meaning of it is measured in the terms of money. And what is the other function of the national income? How and what is the reason why we measure the national income? Because by measuring the national income, you can track a nation's wealth from year to year. Okay, so if we want to compare what is the growth rate of ours, so we have to compare the data of the previous year. Okay, if I want to track my progress, then what should I do? I will compare the data of my previous income to the current income. Okay, so this is the same formula. Okay, it is used to measure and track. Okay, it is used to measure and track nation wealth from the year to year. Okay, and you have also seen that the government is saying that our economy is growing at the 7% rate of 7% rate of 7% rate per year, and also some of the organizations such as UNCTAD, it is saying that Indian economy is growing at the rate of 5.7%, and the IMF is saying Indian economy is growing at the rate of 6.8%. So I hope you understood the statement. Now, what are the methods to calculate national income? So there are several methods. There are several methods which are given by various economists of the time or contemporary time. So what are they? GDP, GNP, NNP, and per capita income, which explain the fact of economic activities. Okay, so these all are the concepts through which we can estimate or calculate the national income of a country. Okay, now come to the very basic very basic points that you have not seen in the books, or nobody had explained ever. So what do once I defined the definition to you, and I said the money value, the national income is defined as the money value of all the final goods and services. Okay, I said it is the money value of all the final goods and services. Okay, so what does the final goods means and what does the goods means? So whenever we go through the economy, we will see two types of goods are produced in economy. And what are they? They are known as intermediate goods and finished goods. So what is the basic difference between intermediate goods and finished goods? So every good that can be utilized for the production of other goods is known as intermediate goods, and the goods which are available for the consumption to the ultimate consumer is known as finished goods. Okay, so thereafter finished goods are also categorized in two different sections. One is consumer good and the other is capital goods. So what is the difference between capital goods and consumer goods? Okay, so all those goods which do not have life, okay, all those goods which do not have life and they are perishable if they are not used, okay, they are perishable if they are not used, are known as consumer goods. Okay, and all those goods which have life and they are durable in nature, okay, all those goods which are durable in nature, all those goods which are durable in nature have have life, or you can say the self life, okay, are known as capital goods. And also you can define this as, though these are the goods which are utilized in the manufacturing process or the production of consumer goods. Okay, all these are known as capital goods. Now we will discuss more elaborately more elaborately what is the distinction between intermediates and final goods. Okay, so there is not any exact definition of defining the nature of intermediate goods and final goods. It depends on the use of the goods. Okay, it depends on the use of the goods. They can be treated as intermediate or finished goods. So let me define the basic or through an example. Okay, so in this picture you are seeing this is the wood. Okay, in the picture you are seeing this is the wood, and if this wood is used in the fire, okay, so it is the ultimate or the final consumption. Okay, in this case if the wood is used in the fire, then it is the final goods in the nature. Okay, and if the woods or the timber is used to make a chair, okay, so in that case the process form of this raw wood, okay, the process form of this timber is the chair. Okay, so in this example you can see there, you can see this is also the finished goods. Okay, this is also the finished goods and this is also the finished goods. Okay, so no, you cannot define which is the finished goods or what is the which is the intermediate goods. It depends on the uses of the goods. Okay, now I think you have understood very well through the examples. Okay, so now come to the question. So what is the concept of the questions? What is the type of questions that are asked in the examinations? Okay, so here you are seeing, why are the intermediate goods are not included in the national income while measuring the national income? So this is a question that was asked in the examinations, and here the options are: it increases income, to avoid double counting, intermediate goods are not good, and they are highly subsidized. So what is the correct option here in the question? What is the correct option? I request you all to share the session so that maximum people can get the benefit of the class. Okay, this is the very important question. Sorry, this is the very important topic in the for your examinations. Okay, very important topic. Okay, this is asked from the SSC or you can say one day examinations to civil services examination, and by watching this video, okay, the whole class, you are able to answer all the questions that are asked in the examinations, okay, previously and in the upcoming examinations also. Yes, what is the correct answer for this question? So intermediate goods are not counted or not included in the national income because the cost or the cost or the value of intermediate goods is already included in the final goods. Okay, so to avoid double counting, of the goods, intermediate goods are not included in the national income calculation. Okay, so suppose that if you have wood which cost rupees 100, and if the wood is processed to make chair, and if the wood is processed to make a chair and it costs rupees 400. Okay, so if you include the cost of intermediate goods, and then the GDP or the total production is rupees 500, but in actual you will see that the cost of rupees 100 wood is already included in the value of chair. Okay, so there is a value addition, in the wood. So what is the value addition? The answer is rupees 300. Okay, rupees 300 is the value addition in the wood. Okay, so this is the actual production, that is rupees 100. Okay, so to avoid the double counting, it is not included in the calculation of national income. Now come to the difference between consumption goods and capital goods. So I have already defined, and by seeing the statements in the slide, you are also able to find the more elaborate meaning of the consumption goods and capital goods. So I have already said that the goods which are of durable nature, they have their shelf life. Okay, and if they are not used, they will remain in working or functioning. Okay, capital goods are used in the production process. I already said that all the tools and machinery which are used in the production method to produce the final goods or the goods needed by the society for the consumption are known as capital goods. And what are the examples? I said tools, implements and machinery. Okay, so you will find that the value of capital goods decreases from time to time. Okay, so the decrease in the value of capital goods from time to time due to the wear and tear of the capital goods, and also due to the obsolescence, or you can say the obsolete technologies. Okay, or you can say the outdated technologies. So it is called depreciation. Okay, depreciation is charged from the from the value of goods. Okay, depreciation is wear and tear of goods. Okay, and also you can say that or obsolescence. Okay, or due to obsolete technology, or you can say the outdated technology. Okay, now come to the consumption goods. What are the consumption goods? Okay, what are the consumption goods? Consumption goods are those which are ultimately available for the consumption by the consumers. Okay, what are they? Such as food, clothing and services like recreation. Okay, so they cannot be stored, they will perish by the time. Okay, are consumed when the purchased by their ultimate consumers. Okay, so this is the basic difference between consumption goods and capital goods. Okay, now come to the next slide, and you will see the circular flow of national income. So what does the mean of circular flow of national income? Okay, so circular flow of income is the never ending process in the economy. Okay, it never ends, it goes on, and if the process ends, then the economy will crash. Okay, so circular flow of income is the never ending process in the economy to survive the economy. Okay, so in the economy, what is the meaning of circular flow of income? So before starting, or before defining the circular flow of income, you have to assume there is a simple economy. You have to assume there is a simple economy. And what does the simple economy mean? That there is the absence of the government, there is the absence of government and household do not save and no trade with other countries. Okay, so these are the basic necessities to calculate the circular flow of income, or to the to define the circular flow of income. So I repeat, what does the simple economy mean? Simple economy means that every person in the economy did not save their income, and there is the absence of government. And what does the absence of government mean? This means that no income is taxed. No income is taxed. All the income that is produced by the, or that is procured by the citizens or residents is available for the consumption. Okay, and there is no trade with other countries. The country is closed economy. Okay, so in this picture you are seeing that the firms are available and household, or you can say the consumers, are available. So there are two parties in the economy. One is firm and the other one is household. Okay, so what does the circular flow of income wants to say? It wants to say that all the goods and services that are produced by the firms are purchased by the sorry, okay, all the goods and services which are produced by the firms are purchased by the household. Okay, so what does it mean? It means that the actual production of goods and services is equal to actual spending on the goods and services. Okay, I think it is all clear. Now come to the point C. So how does this production happens? So the production happens with the help of household sector, or you can say the factors of production. Okay, and they provide the factor services such as land, labor, capital and entrepreneurship. Okay, and on behalf of this they get factor payments. Okay, so there are 3 points in the circular flow of income. Okay, what are they? A, B and C. So at point A, if you want to calculate the national income, then the point A is known as expenditure method. Okay, so all the expenditure which happened in the economy, if we add all the expenses, then we can get the income of the economy. Oh, okay, or the residents of the economy. And at the point B, we see that all those all those goods and services that are produced in the economy is equal to the all spending done by the households. Okay, so at point B, if we add all the goods and services produced in the economy, then we can get the income, and this is known as the production method. Okay, now coming to the point C. At point C you will see that the households provided factor services for the production of the goods and services, and they got the factor payments. So all the income which household got from the firms, okay, household got from the firm, they spend it in the goods and services that are produced by the firms. So all these 3 points A, B, C have the same value. Okay, all these points have the same value. Now I am using a example in this case. Suppose that in an economy, goods and services are produced of ₹100. Okay, so all goods are consumed by the household sector. Then what they have spent? They have made an expenditure of ₹100. Okay, and how they get ₹100? How they get ₹100? They get ₹100 from the firms in as the means of factor payment. Okay, now I think all these points are clear to all of you. Now come to the circular flow of income, and you will see that the 3 phases of a circular flow of income. One is production of goods and services, other is disposition of expenditure of income, and the generation or distribution of income. So these are the never ending process in the economy. Okay, so in an economy, three activities are never ending. I already said in previous slides that production of goods and services, distribution of income, and disposition of income. So these are the never ending processes in the economy. If any of the process stops, then the economy will crash. Okay, now, so these all are the basic concepts you have never studied anywhere in the any classroom. Okay, all the classroom, all the teachers, all the platforms start with the GDP. Okay, but I have taught you the basic concepts or basic things that you should really know, so that you can understand the measurement or calculation of national income very easily in a smart manner, so that there is no need to memorize the concept. Okay, you have to uh, understand the meaning, so that it remains in the memory forever. Now, what is gross domestic product? So as you are seeing, this is the our country, that is our loving country Bharat or India. And in this figure you are seeing that, in this image you are seeing that this is the image or logo of the ONGC Videsh Limited, or OBL, ONGC Videsh Limited. And in this picture you are seeing the company that is known as Honda, So what does the GDP mean? GDP means that the money value of all the final goods and services produced within the domestic territory of a country during a financial year. Okay, it is known as national income. And what does this mean? It means that in this, in the boundary of the country, this is our nation or our loving Bharat. Okay, our loving country. So this is the boundary of a country, and within this boundary, whatever produced in the country is known as the gross domestic product. Okay, this is known as the gross domestic product. So in this form, or you can say that in this formula or in this concept, the income that had been made by the Honda company is included in the GDP, while the income earned by the ONGC Videsh Limited is not included in our GDP. Okay, because it is outside India and Honda is within India. Okay, now here, this is the method of calculating GDP. What is the first one? Is expenditure method. So what does this expenditure method mean? It means that GDP is equals to C plus I plus G plus X minus M. C plus I plus G plus X minus M. So it is the formula of calculating expenditure, formula of calculating national income by the expenditure method. So what does this formula mean? What does this formula signify? It signifies that whatever expenditure made on the consumption and investment, government expenditure, and the income arise from the export, and the income which is drawn out of the country, that is import, is included, it gives us the accurate figure of the GDP or income. Okay, so all the consumption which is made in the nation or the country is included, and whatever investment on the durable goods made, it is investment, and whatever expenditure made in the country by the government of India, or you can say the government of any country, and whatever we have made income from the exports. Okay, we have to add, all we should add, and minus the income which we paid for the imports of goods and services. Okay, so when we get the summation of this total, then we get the GDP or gross domestic product. Okay, so I think you all have understood this formula very well, and this is the very important formula and asked in various examinations. Okay, So this is the expenditure method and it is the first method. Now come to the gross value added method, or you can say the production method. What does it say? So it says that in every stages of the production the value is added, or you can say the enhancement in the value of the goods. So we have to add all the values, all the value addition in the production process. Okay, so this is the iron ore. Okay, this is the iron ore and it is freely available. Okay, it is freely available on the planet earth. Nobody had spent it on the manufacturing of the iron ore. Okay, so the expenditure is made on the extraction of the iron ore, but it is freely available and we have to take the value of this iron ore as 0. Okay, suppose that in this case the iron ore is refined and converted into steel sheets. Okay, and the value here goes to rupees 100. Okay, the value here goes to rupees 100. And now come to the final product, or you can say the this is the bucket. Okay, so the value addition here is rupees 100. Okay, the value addition is rupees 100, and the cost of this bucket is rupees 350. Okay, the cost of this bucket is rupees 350. So what is the value addition here? So what is the value addition? The value addition here is rupees 100, and the value addition here is rupees 250. Okay, value addition here is 250. So when we add the total sale. Okay, when we add total sale, then we find that rupees 100 for 100 rupees is spent for the purchase of the steel sheet, and rupees 350 is spent on for the purchase of the bucket. So total sale here is rupees 450, but in actual in the cost of rupees 350, the cost of rupees 100 steel sheet is also included. Okay, so in the value addition method we have to add the value addition at every stage. Okay, we have to add the value addition at every stage. So the total value addition at every stage, here it is rupees 100 and here it is rupees 250. Okay, so the total gross value addition here is rupees 350. Okay, gross value addition here is rupees 350. Okay, so this is the gross value addition. Okay, this is the total sale. Okay, so this is the formula. Gross value addition is equals to total value of sale, that is rupees 450 minus cost of goods sold. So the total value of rupees 450, but here the cost of goods that is sold is rupees 100. So we have made an expenditure of 100 rupees to purchase the steel sheets to manufacture the bucket. Okay, so this is the cost of goods sold. Okay, so this is the gross value addition, rupees 350. Okay, and what is GDP? GDP is equal to GDP at current market price is equals to GBA, gross value addition, that is rupees 350 plus indirect taxes minus subsidies. Okay, so this is the very important formula you have to remember for the conceptual. Okay, so what happened? Okay, now this is the this is our slide. Okay, due to some technical mistake, the other slide is open. Okay, so I hope you have understood the value addition method very easily and all the points of the value addition method are clear. Now come to the third method, that is known as the income method. Okay, so first of all you should know what are the factors of production. Though there are 4 factors of production you have to remember, and what are they? They are land, labor, capital and entrepreneur. Okay, what are they? they are land, labor, capital and entrepreneur. So these all are the factors of production which are utilized for for producing the goods and services in the economy. Okay, so what is the remuneration they get? What is the remuneration they get in return of the uses or the utility of the factors of production? So labor get the remuneration as wages for the use of their services, and land get the remuneration in the form of rent, and capital get the remuneration in the form of interest, and the entrepreneur who takes the risk and keep patience while in the production process, so he takes the profit at their home. Okay, so all these income to the factors of production is added and it makes gross domestic product. Okay, so I have taught you three methods of calculating national income. What are they? They are first, expenditure method, in which all the expenses which are made in the economy, okay, so whatever money spent in the economy is added, and this is the all income which is present in the economy. Okay, and now what is production method? In the production method, we add the value addition at every stage and we finally get the gross value addition. Okay, and gross value addition is the total value added in the product, and when we add the indirect taxes and minus subsidies, we get the GDP at market price. Okay, and this is the income method. So here question arises, and this is the same format in which question is asked in the exam. Okay, so what is the question? Which of the following method is which of the following is the method of measuring national income? So question is asking which is the method of measuring national income, and there are options are available: output method or value addition method, income method, expenditure method, and all of these. Okay, all of these. So what is the correct answer here? So as you have already studied or already seen that the output method, income method and expenditure, so these all are the methods which are used for calculating national income in India. So the correct answer in this slide or in this question is all of these. Okay, all of these are the correct answer. Okay, so in this figure on this image, you are seeing there are three methods: income method, expenditure method and output method. Okay, and we have understood the all the methods very comprehensively. Okay, now come to the gross national product. Okay, what is gross national product? Gross national product, saying that, is an economic statistic that includes GDP. Okay, which includes GDP plus all the income which is made by the residents from overseas investments. Okay, minus income earned within the domestic economy by the foreign residents. So what does this mean to say? What the definition want to say? It will become very clear from this example. So as you have already seen that all this income which is earned within the domestic territory of India is GDP. Okay, all the income which is earned within the domestic territory of India is known as GDP. Okay, and we have seen that Honda is a car company and it is a Japanese company which is producing the cars in India, while ONGC Videsh Limited is working overseas and they are earning income from the foreign investments. So what does the GNP say? It says that all the income which is earned within the domestic territory of India by the factors of production overseas, okay, by the foreign factors of production, is kept aside, and all the income which is earned by the residents of India from overseas investments. Okay, so these are the Honda is a factor of production employed in India. Okay, employed in India, while the ONGC Videsh Limited, or you can say the OVL is a factor of production of India which is employed overseas, So what we have to do? We have to do, suppose that suppose that the GDP of a nation is rupees 120. Okay, this is the GDP of a country. Okay, this is the GDP of a country, that is 120 rupees, and the income earned by Honda company is rupees 10, and the income earned by the ONGC Videsh Limited is rupees 8. So what we have to do? What we have to do? So we have to add this income in the GDP. Sorry, we have to minus this income in the GDP, and we have to add this income in the GDP. So what is the meaning? Plus 8 and minus 10, or you can say that, or you can say that minus 8 plus 10 is equals to rupees 2, that is minus. Okay, and the value comes in minus. So what you have to do? 120 1 sorry 120 minus 2. So what is the answer? The answer is 118. The answer here is 118. So what is the formula? So what is the formula? The formula is GNP is equals to GDP plus net factor income from abroad. Net factor income from abroad. So this is the formula, or you can say that GDP plus NFIA in short. Okay, so in the case of India, GNP is always less than GDP because the factors of production employed in India of foreign nations are very much, but on the other hand, the factors of production of India are employed less in comparison in foreign nations. Okay, so this is the question, and what is the question saying? That if for a country the net factor income from abroad is 0, okay, the net factor income from abroad is 0, then what is the correct option here? Okay, as you have already seen that GNP is equals to GDP plus NFIA. Okay, so in the case of India, the factors of production of India are not employed that much in foreign nations. Okay, that much in foreign nations, but on the other hand, the foreign factors of production are employed very much in India, and that's why the net factor income from abroad is always negative in the case of India. But in this case, it is saying that this income becomes 0. In this case, the question is saying that this income becomes 0. Then what will happen? Then the GNP, gross national product, is equals to GDP. Gross national product is equals to GDP. Okay, so in this question, the GDP is equals to GNP is the correct answer. GDP is equals to GNP is the correct answer in this question. So you have to remember that this is also only possible in the case of only possible in the case of closed economy. Okay, closed economy. This is only possible in the case of closed economy. You have to remember, very important. It is very important. It is asked in several exams. Okay, now come to the other concepts. So before going to the other concept, you have to understand the difference between market price and cost price. So what does this mean? Market price is the actual price which a consumer pays. Okay, it is the actual price which consumer pays to buy a product for their users. So buy okay. And what is the factor cost? What is the factor cost? Okay, what is the factor cost? It is the cost of an item, goods or services in terms of various factors which have played a part in the production process. So what is the factor cost? It is the total cost which is incurred on the production of goods and services. Okay, it is the actual cost of production. It is the actual cost of production, and it did not include any kind of subsidies or indirect taxes. Okay, you have to remember that it is the actual cost of the production, and it did not include any kind of interest, that is, or any kind of indirect taxes and subsidies. Now come to the net national product. What does this mean? Net national product means that, so before beginning the net national product, you have to understand the meaning of gross and depreciation. Gross and depreciation. So there is a formula or the basic concept you have to remember, so that you can solve the questions or the formula based questions very easily. So whenever you see question is asking about the national, question is asking about the national, then you have to remember that national is equals to domestic plus net factor income from abroad. Okay, national is equals to domestic income plus net factor income from abroad. As you have seen in the earlier formula that we have calculated the GNP, and in this formula we have we have added the net NFIA in GDP. Okay, so what changes you have seen in this formula? Okay, what changes you have seen in the term? You have seen that the domestic, okay, you have seen that the domestic changed to net. Okay, domestic changed to net. So in every formula where domestic is present and NFIA is added, then you will get the value of net. Okay, you will get the value of net. So you can say that in every formula when D plus NFIA, then you will get national. Okay, so I will write this more clearly. Whenever you see domestic and you add net factor income from abroad, then you will get national. Okay, and whenever you see any formula in which gross word is used and we had subtracted the depreciation, okay, we had subtracted the depreciation, then the answer is net. Okay, so net is derived by gross minus depreciation. So if you remember these both concepts, then you can solve the formula based questions very easily. Okay, so it is the market value of net output of final goods and services produced by the economy during a year and net factor income from abroad. Okay, so NNP at market price, NNP at market price is equal to GNP minus depreciation, GNP minus depreciation. So what you are seeing in this formula, you are seeing that the GNP minus depreciation, GNP minus depreciation is equals to net national product. Okay, so the G is changed to N, G is changed to N. Okay, the gross changed to net when depreciation is subtracted from the gross. Okay, and NNP at factor cost is equals to NNP at factor cost is equals to NNP at market price minus indirect taxes plus subsidies. Okay, so to understand the concept more elaborately, I am going to explain it with an example. Okay, let's see. So you have seen the LPG cylinder and you have also used the petroleum products. Okay, so what is the basic difference between them? What is the basic difference between them, or you can say the what is the methodology of arriving the price on the LPG and petrol. So let's discuss. Okay, so the production or the production cost or the factor cost of producing both the commodities is, suppose that the LPG cylinder is produced at a cost of rupees 100 and petrol is produced at a cost of rupees 50 rupees per liter. Okay, so when you go to purchase the LPG and petrol, you will find that the market price of this commodity is rupees 700, but on the petrol you have to pay rupees 90 per liter. Okay, 90 per liter, 90 per liter. So what is the difference here? What does this mean? It means that in this situation, rupees 200 subsidy is paid by the government to make it affordable so that every person can purchase the LPG cylinder. Okay, but on the other hand, क्या कर रहे हो ये? Okay, so in this case, what you are seeing that 40 rupees extra you are paying 40 rupees extra, or you can say the 40 rupees per liter. So what, how does it happen? So this is the indirect taxes. Okay, this is the indirect taxes you have paid on the consumption of petrol. Okay, so in this case, if you want to arrive at the factor cost, what you have to do in this case, you have to do 700 plus 200. Okay, this is the market price, and this is the subsidy, and in this case what you have to do, 90 minus 40, 90 minus 40. Okay, to get this is the market price, and this is the indirect taxes. Okay, this is the indirect taxes. So the formula is arrived now. So what is the formula? You have seen that factor cost can be arrived by market price of the commodity and adding subsidies and minus indirect taxes. Okay, so the factor cost of any commodity can be arrived by adding the subsidies on the product and deducting the indirect taxes on the product. Okay, so this is the formula you have seen in this slide. Okay, what is this? NNP at factor cost is equals to NNP at market price minus indirect taxes, which we have already seen in the example, and plus subsidies. Okay, so this is the last formula in the process of calculating national income. And what does mean? This is the actual national income, which is known as national income at NNP at factor cost. So we have arrived, or you can say we have derived the our national income. Okay, so this is all about the formula. Now come to a very, very important web chart, and through this web chart you are able to get the comprehensive approach to derive the formulas. Okay, so what is this formula or web chart is going to say? So in this formula you are seeing that GNP at factor cost, and when we minus the depreciation, then what you have arrived? You have arrived at NNP at factor cost. So what does changed in this formula? So what does changed? The gross is changed to net. The gross has changed to net. Why? Deducting the depreciation. Okay, by deducting the depreciation. Okay. And when the same formula GNP, the net factor income from abroad, is deducted, net factor income from abroad is deducted, then we arrived at the gross domestic product at factor cost. Okay, so we have seen that GNP is equals to GDP plus net factor income from abroad. So it is the reverse formula. It is the reverse formula. Okay, if we want to go to the GNP at factor cost, what we have to do? We have to do GDP plus net factor income from abroad. Okay, now come to the NNP at factor cost. So GNP at market price minus depreciation is equals to NNP at market price. So what you are saying that the G is changed to N. G is changed to N, and when net indirect taxes is minus, then the market price changed to factor cost. Okay, factor cost. So it is the very important formula where you can arrive all the formulas of the national income, and you will feel very safe in your examination. Now come to the question answer series, and here are the questions for you that are asked in the examinations, and there is a great possibility that they are revised in the upcoming examinations. So which one is true? The first option is saying GNP is equals to GDP plus NFIA. GNP is equals to GDP minus depreciation, and NP is equals to GNP plus depreciation, GNP plus depreciation, NDP is equals to GDP plus depreciation. So as we have already studied the whole concept of these formulas, so by seeing the first option you can mark it correct. Okay, so what you have seen, when we added the net factor income from abroad in the GDP, we got the gross national product. Okay, now come to the option number B. What mistake is done in this? So whenever you minus the depreciation from GDP, you will get NNP. Okay, NDP. You will get NDP because gross, whenever the depreciation is subtracted from the gross, you will get the net. Okay, and nothing will be changed. Okay, only the G will be changed to net, and the same domestic product will be seen in the formula. Okay, now what does this mean? NNP is equals to NNP is equals to, as we have seen in this formula, NNP is equals to GNP minus depreciation. Okay, so what is the mistake here? We have to change this to minus to get the NNP. Okay, and option number D, NDP is equals to GDP plus depreciation. What we have to do? We have to change this to minus to get the NDP. So this is the very interesting formula question for the examination. Now come to the personal income. What does this mean? Personal income is the money received by an individual from the all possible sources before the direct taxes. Okay, before the direct taxes. So all the money income received by an individual and households from all possible means, all possible sources of income in a country is known as personal income. Okay, so what does the formula of personal income says? Personal income is equals to national income minus corporate income taxes. Okay, so whatever the income earned by the corporates and it is given in the form of corporate taxes is to be subtracted, because it is not available for the use of the households or the individuals of a nation, because it is paid to the government. Okay, and undistributed corporate profit. So whatever profit which is not distributed to the individual or household sector is to be subtracted from the national income. Okay, and social security contributions are also to be subtracted because they are not available for the use or for the disposal of the company, for the disposal of the individuals, and transfer payments should be added over here. So whatever company has paid to the individuals for their livelihood is to be added in this personal income. Okay, very important formula you have to remember, because this is asked in the various examinations. What does it mean? National income minus corporate taxes, corporate indirect taxes, okay, and undistributed corporate profit which is not available for the disposal of the individuals or the households, and also the social security contributions plus the transfer payments made by the corporates to the employees. Okay, this is the personal income. And what does this disposable income mean? So disposable income means all the income which is available for an individual for the disposal or the use for the personal use. So what is this? It is the income left with the individual after the payment of the direct taxes. Okay, so all the income which is left with an individual after paying the direct taxes is known as disposable income, because it can be disposed on the purchase or the expenditure of the individual. Okay, so this is also the important formula for your exam. Personal income minus direct taxes is equals to, okay, now come to the per capita income. What does the per capita income mean? Per capita income means that the total income or the national income of a country when divided by the total population is known as the per capita income. Okay, so what does per capita income means? It is the average income made by or earned by an household of a country. Okay, earned by an individual of a country. Okay, it is the per capita income. Okay, very important formula. And now, what does the GDP deflator mean? Okay, we have understood the GDP, we have understood the NDP, we have understood the NNP, we have understood the NNP at factor cost, NNP at market price. Then what does the GDP means? GDP deflator means, actually GDP deflator has nothing to do with the national income. Okay, first of all keep in mind, GDP deflator has nothing to do with the national income. It is an approach to calculate the inflation in an economy. Okay, it is an approach to calculate the rate of inflation in an economy. You should remember, so that if anybody asks what is the GDP deflator mean, then you can answer it very easily. Okay, so before going to the definition, first of all we have to understand this with the help of example. Okay, so in 2012, if a company produced 100 units of bread, okay, in 2012, a company produces 100 units of bread at the rate of rupees 100 each. So what is the actual production? What is the actual production of the company? So the GDP is equals to 1000. Okay, GDP is equals to 1000. But in 2014, the company produced 110 units. So you can assume that, you can see that there is an increase in the production of 10 units in the production of breads. Okay, and if each bread is sold at a rate of rupees 15 each, so what is the nominal GDP? What is the nominal GDP in this case? You will multiply 110 into 15, then you get 1650. So it is the nominal GDP. So what is the difference? What is the difference between nominal and real GDP? So if you want to calculate the real GDP, what is the actual production in the economy, then you have to multiply the base prices, or you can say the constant prices of bread, to know the actual production of the company. So if you multiply 110 with 10, you will get the actual production is 1100. Okay, so in this case you are saying that the value you got 1650 is not the actual value or the real production of the economy. Okay, the 1650 came due to the increase in price of bread from 10 to rupees 15. Okay, but the actual production is rupees 1100. Okay, so what you have to do for to calculate GDP deflator, you have to divide the 1650 by 1100 and you will get 1.50 as the value. Okay, 1.50 as the value. So what does this mean? This means that if the value comes 0.50, 1.50, you can see that the price of a commodity, the price of the commodity increased by 150%. 150%. Okay. The actual price was rupees 10 and it became 15 in this year. So then you can see the price became 150%. Okay. 150%. Okay. Or you can see the 50% increase in the value of the bread. So the GDP deflator is a means to calculate or measure the inflation in the economy. Okay. I assume that you have understood the concept very easily. I write here, it is a it is a concept to measure the inflation in the economy. Okay, to measure inflation. It is a measure of inflation. Okay, it is the ratio of nominal GDP to the real GDP, as we have already seen that this is the nominal GDP and this is the real GDP. So whenever you divide the nominal GDP with the real GDP, then you get the GDP deflator. Okay, so real GDP is the value of goods and services at constant prices, which I have already seen that 110 multiplied by 10 is the real GDP at constant prices. Okay, so the nominal GDP is value of goods and services at current prices, and GDP deflator is equals to nominal GDP upon the real GDP, and this formula has been asked in several examinations. Okay. Yes. So this is a very important formula and you have to remember for your upcoming examinations. So GDP deflator has nothing to do with the national income. It is the formula which is used to calculate or used to measure the national income of a nation. Now, question here, who is the father of national income accounting? Here the options are Simon Kuznets, Sir Richard Stone, John Maynard Keynes, Alfred Marshall. So what is the correct answer in this question? What is the correct answer in this question? What is the correct answer in this question? So the father of national income accounting is Simon Kuznets. Okay, the father of national income is Simon Kuznets. Now, next question. Accounting of a national income at constant prices is known as. Okay, accounting of national income at constant prices is known as. Here the options are real income, domestic income, money income and current income. What is the correct answer here? What is the correct answer here? Yes, what is the correct answer? So the correct answer for this question is it is the real income. It is the real income. Okay, so when we multiply the production by the prevailing price, then you will get the nominal nominal value. So national income of India is computed by which of the following? Here options are National Statistical Office, Niti Aayog, Ministry of Finance and option D, SEBI. So what is the correct answer here? What is the correct answer here? So the correct answer here is National Statistical Office. Okay. Earlier it was known as the Central Statistical Office and it was merged with National National Sample Survey Organization on 23rd May 2019, and from now and from there there it is known as National Statistical Office and it is situated at New Delhi. Okay, so this is the organization responsible for calculating the national income of India. Now come to the question. Next question, national income is the sum total of dash earned by the dash of a country. So what is the correct answer for this question? Here options are factor income residents, factor income non-resident, transfer income non-resident, transfer income residents. What is the correct answer for this question? What is the correct answer? So the correct answer here for this question is factor income and residents. Okay, national income is the sum total of factor income earned by the residents of a nation or a country. Now, what do you mean by resident and citizen? So I make you clear that residents are not the citizens of a country. I once again say that every time all the citizens are not residents, and also all time all the residents are citizens of a country. Okay, we are born in India and also living in India. So in our case, we are both the citizen of India and also the resident of India. Okay, so what is the exact definition to be qualified as a resident of India? So in previous year, if somebody stays in India for a total of 182 days, for a total of 182 days, then he will be treated as the resident of India. Or if he has been in India during the 4 years immediately preceding the previous year, okay, if immediately preceding 4 years he have resided in India at least 365 days or more and has been in India for at least 60 days in the relevant previous year. Okay, so if somebody had spent 60 days in the previous year and also preceding previous year he had stayed in India for a total of 365 days, then he can be treated as a resident of India. Okay, and we qualify both the conditions because we are staying in India from our birth or since our birth. Okay, now come to the question, what is the consumption of fixed capital is called? As we have already seen that the wear and tear or the obsolete or due to the obsolete technology of the capital goods, the value of these capital goods decreases time to time. Okay, and what is called? It is called capital expenditure, it is called investment, it is called depreciation, it is called revenue. So what is the correct answer for this question? So what is the correct answer here? So the correct answer here is it is called depreciation. It is called depreciation. Okay, it is called depreciation. Now come to the next question. Dash refers to never ending flow of activities of production, income generation and disposal of income involving different sectors of economy. Here options are flow of income, circular flow of income, expenditure of income and none of these. So dash refers to the never ending flow of activities. As we have already discussed in previous slides that there is a process which is never ending, and it is the production of goods and services. Okay, production of goods and services and distribution of goods and services and the disposal of income. So it is known as circular flow of income. It is known as the circular flow of income. So here option number B is correct. So here option number B is correct. Now come to the next question. The question is saying that the economic consequences of peace 1919 is written by whom? The economic consequences of peace, a very important book which is written in 1919. So who is the author of this book? Here options are John Maynard Keynes, Adam Smith, J.B. Say, Lionel Robbins. So these all are the economists, or you can say the very famous economists of that time. So who had written the economic consequences of peace? So this book had been written by the John Maynard Keynes, or you can say J.M. Keynes is the author of this book. Very important, economic consequences of peace. Now come to the next question. So these all are the questions that are asked in the previous years. Okay, so I have collected all these questions for your convenience. Hindu rate of growth is coined by Professor Raj Krishna, Professor P.C. Mahalanobis, Professor Amritya Sen, and none of these. None of these. What is the correct answer here in the question? Who had coined the term Hindu rate of growth? Okay, so so the population of Hindu grows at a very slow rate, and in the economy, and in a year, the economic growth of the economy is very slow. So an economist has said that the economy is growing at the rate of Hindu rate of growth. So this is the term coined by Professor Raj Krishna. Professor Raj Krishna had coined the term. Okay, now come to the next question. Here the question is saying dash is the market value of all the final goods and services produced within the domestic territory of a nation during a year. So what is the correct answer in this question? Here options are GDP, NDP, GNP, and NP. So what is the correct answer here in the question? What is the correct answer here? So here I have already said that GDP is the market value. GDP is the market value of all the final goods and services that are produced in the nation or the domestic territories of a nation during a year. Now, next question. Which one is included in the primary sector? Which one is included in the primary sector? So first of all, discuss what do you mean by primary sector and what is primary sector is actually means. Okay, so the primary sector is the sector in which the manufacturing process or the production happens with the uses of natural resources. Okay, so the natural resources are deployed in the production of goods and services. It is known as only goods. It is known as primary sector. Okay, such as the agriculture, forestry, mining, crude oil. Okay, dairy. These all are the sectors of, these all are the primary sectors. Okay, these all are the primary sectors. Okay, so the correct answer for this question is all of these. All of these is the correct option here for this question. Now come to the next question. Which of the following is not an example of transfer payment? Is not an example to a transfer payment. So transfer payment is the income which is received by the beneficiaries for the non-contribution in the national income or the production activities. Okay, so all the income which is received by the old age or the senior citizens in the form of old age pension, they have not contributed in the production of anything in the economy, and it is only a transfer payment. So it is not included, sorry, it is included in the transfer payment. And whenever you give gift to other person, so this is also a income to a person which he had received for not contributing not contributing anything in the economic production. Okay, and donations and grants, so this is also an income to an individual and they have not contributed anything in the economy in the production of goods and services. But when fees to a chartered accountant is paid, it is not a transfer payment. It is not the transfer payment, you have to remember, because he is charging for the consultation. Okay, he is charging for the consultation which he had given to any person. Now come to the next question. National income is a flow concept, stock concept, static concept, none of the above. So what does this mean? National income is a flow concept, stock concept, static concept, or none of these. So as we have already seen, the national income is a flow concept. Okay, it is a flow concept. Okay, so this is the last question, and I'm going to discuss some more things which are asked in the examinations, and these are the historical aspect of the calculating national income. So you have to remember for your exam. So when we talk about the who had made the first attempt, okay, Dada Bhai Naroji. Okay, you have to remember that Dada Bhai Naroji, Dada Bhai Naroji is the first person Dadabhai Naroji made the first attempt. Dadabhai Naroji made first attempt to calculate national income. Made first attempt to calculate national income. Okay, and the attempt was made in which year? Then the answer is 1867-68. Okay, answer 1867-68. So you should remember for examination, and it is described in a book known as Poverty and Un-British Rule in India. Okay, he had written a book known as Poverty and Un-British Rule in India. Poverty and Un-British Rule in India. It is the book in which he made the elaborate explanation of this point. Okay, national income. And he had also propounded a theory known as property. He had also propounded a theory known as drain theory of wealth. Drain theory of wealth. Okay, so these all are the important points, and these are asked in the exams. Okay, and okay, these all are the facts associated with Dadabhai Naroji, and in the same year, the rupees 20 per year. Rupees 20 per year is the per capita income of India. Okay, it is the per capita income of India he had calculated. Okay, this is the real picture of the British era in which they had exploited our resources and make us poor. Now, if somebody asks the first scientific attempt, first scientific attempt, first scientific attempt to calculate national income, to calculate national income is made by whom? The answer is the answer is Professor V.K.R.B. Rao. Okay, Professor V.K.R.B. Rao is the person who made the first scientific attempt to calculate the national income. Okay, and there is a point you should remember, that National Income Commission, National Income Commission was established in 1949 under the chairmanship of, and who is the chairman? Under the chairmanship of Professor P.C. Mahalanobis. Professor P.C. Mahalanobis. Okay, so these all are the important facts and figures related with the national income calculation, and these are the most important points which you have to remember that can be asked in the upcoming examinations. So it is all about the national income. I had covered all the aspects of the national income and all the related aggregates, and also the practical questions that are being asked, and there is a great possibility that they can be asked again and again in the upcoming examinations, is covered in the special session. Okay, so it is all about national income, and we have discussed it very comprehensively so that no concept is left behind and you feel safe when you attempt a question in the examination. Okay, so I'm going to end this classroom, and thank you all for coming and joining the session. I request you all, please share the session if you feel that this session is really good and you have learned a lot. Okay, so this is all about national income, and I say goodbye to all of you. Thank you. Vande Mataram.